Morning, guys. It's Monday, August 4th, 5:24 a.m. Central Time. Welcome to your daily dose of depressing grain market news with Joe and Mackenzie. Mackenzie, do you like being the bearer of bad news every single day?
Absolutely not. No.
I don't either, but this is our job, and I'm not here to piss on your leg and tell you it's raining, as they say. So we're going to kind of tell you how it is, and it's not always fun to do. I wish the market was up and we had some good news to report to you. We really don't. I'm going to title this like Daily Dose of Depression. You think that'll get a lot of clicks? People are
I
going to
think
click
it
on
I
that.
think it just might, yeah.
It's going to be like the least watched video we've ever done, probably. Anyways, let's start off with the funds who are now short the grain markets across the board.
So the funds barely reduced their net short position in the corn market last week. For the week ending Tuesday, July 29th, large money managers were net sellers of 181 corn contracts. The funds were also net sellers of 34,000 soybean contracts. The net short position of 25,000 soybean contracts is the largest since early April. And lastly, the funds were net sellers of 13,000 contracts of SRW wheat on the week.
We'll run through our fund tracker charts real quickly here. Premium subs, these are always available to you guys in the Monday morning email. So the funds are net short 151,000 contracts of corn. That's not a historically like massive net short. It's just kind of a, yeah, we're short the market. We don't like the market. We prefer to be short. It is an opinionated, I would call it, net short position, but not historically excessive. I worry that let's skip to soybeans. I worry that what is happening or has happened in corn could happen in soybeans now that the tide has turned a little bit. We've kind of cracked some technical support. You're below that $10 level. Maybe the funds will continue to ride the momentum train here to the downside. They've been doing exactly that in the wheat market for a long time. I'm going to do our ad real quick this morning because it applies to this. Not Your Father's Markets. Pete Meyer was on Friday, and he talked about how the markets have changed. The markets that we are dealing with and trading and that you guys are navigating today are not the same markets that we dealt with even 10 years ago. A lot of the participants have changed. The way that the funds view the marketplace has changed and changed drastically. Pete, in his former career, was an analyst at S&P Global, and he worked with the people that we call the funds. And he ran through this whole situation in like a 30-minute video on Friday and talked about what has changed, who has changed, what is the focus now in the markets, and why are things acting the way that they do. It seems like the market's immune to good news, right? We only sell off on bad news, and we trade that for now, but things will change. And Pete kind of explained why. This is a really interesting video. If you guys are looking for some context, great stuff. Remember the premium deal is $50 a month. You can cancel at any time. There's no other fee, no other obligation. Nobody tries to sell you anything else. Sign up at standardgrain.com. I will forward you a copy of this morning's email, which includes that video.
Another heat wave is on tap for the U.S. Corn Belt. Based on GFS Ensemble data, our friends at CropProphet estimate that U.S. corn areas will run 2 degrees above normal on average over the next 7 days. Heat is exaggerated during the 8 to 14 day period when temperatures are slated to run 3.8 degrees above normal on average. Rainfall is slated to run slightly below normal on average during the next 2 weeks.
Yeah, so we've got a little bit of heat coming back in. Here's an example of one of the warmer days that you'll see here over the next week. On Friday, you're going to see some highs in the Corn Belt and in the Midwest in the upper 80s, low 90s. I mean, it's August. Yeah, it gets hot. We're going to be a little bit above normal. The market clearly not concerned about this. To look at rainfall placement, really not a whole lot for the Central Corn Belt over the next 5 days. And the weekend was pretty dry over a lot of the Corn Belt also. You will see some rain over the next 5 days in places like North Dakota and kind of that western part of Minnesota, a little bit of eastern Nebraska and northwest Iowa, perhaps, and then kind of like Kentucky, maybe southern Indiana, southern Illinois, those places. Then you've got rain that's a little bit more widespread across areas of the Corn Belt during that 5 to 10 day period. So maybe there's some weather that you could be concerned about here, but the market is clearly not concerned. And we had so much rain during the month of July in so many places that I don't know if a little bit of dryness and a little bit of heat is going to hurt very much. And some people might even argue that it would help.
A U.S.-China trade deal may be nearing completion, as Treasury Secretary Scott Bessent expressed optimism about a potential deal on Friday. Earlier last week, U.S. and Chinese officials met in Stockholm to further discuss trade negotiations. Although some details still need to be finalized, Bessent believes that the two sides have the framework for an agreement that would benefit both nations. Any final deal will require President Trump's approval, and the deadline to reach an agreement is August 12th.
I don't necessarily know that a trade deal, even if there's a trade deal, they strike a trade deal, they announce it, they have some sort of ceremony. It doesn't mean that China's going to come in and buy U.S. soybeans right away. China has bought 0 bushels exactly of new crop U.S. soybeans, and that is why we have the worst book of soybean sales for the new crop marketing year of the last 20 years. You got to go back to 2005 to find a book of new crop soybean sales that is this bad. My opinion is this. I think that China is avoiding U.S. soybeans because maybe there's demand reduced a little bit. Maybe Brazil's got big supplies, and maybe we're just not priced right. I think when the price is right, China will come in and buy U.S. soybeans. But for right now, in the words of Happy Gilmore, did you watch Happy Gilmore too?
Yeah, I did.
Anyways, in the famous words of Happy Gilmore, the price is wrong, bitch. And right now, we need to maybe reduce our pricing a little bit and become slightly more competitive. China's going to need beans in that new crop U.S. time slot from, call it October through December. And I think they're going to buy beans from the United States. That's still my opinion. And I believe that they'll come in and buy them. They just haven't done it yet. And it might be a reduced book of business to China.
A bit more on China. China booked additional purchases of Argentine soybean meal last week, with a Chinese buyer securing 30,000 metric tons. The deal is the third of its kind since June. Prior to these recent purchases, there had been no activity since China first approved Argentine soybean meal imports in 2019. The renewed interest comes as Chinese feed makers look to take advantage of cheaper supplies. Argentine soybean meal has become more competitive since the government reduced export taxes from 31% down to 24.5% earlier this year.
I liked Happy Gilmore too, for the record. There were a lot of haters. They were like, "Oh, the jokes are stupid." Like, did you not see the first one? The jokes were stupid then too. It's just you were 12 years old when you watched it, and now you're like, a grown man thinking that the same. Whatever. In any case, China is the world's largest soybean meal consumer, and it would be cool if we had a trade deal with China and they bought some from the United States, because we are going to have more meal than we know what to do with. Meal is very, very, very cheap. We are nearing our what I would call pre-COVID, post-ethanol lows in this like 250, 260 neighborhood. It's really, really cheap. You can't really show, like, it's hard for me to illustrate to you that we have like a ton of meal floating around, because we don't really do meal ending stocks. It's not something that stores well. Nobody likes to store it. It's more of like a just-in-time product, and it's spoilage risk, and it's just a messy thing. Nobody likes to deal with meal. But in any case, it's cheap. I think it's going to remain cheap. If you're a meal user, this is a great deal for you that could probably persist for a long time, given what's going on with the U.S. and the crush expansion, and now China's talking about reduced hog herd. There's going to be a lot of meal floating around, I think.
Poor weather, harvest delays, and farmer stockpiling have hindered wheat exports from Russia, Ukraine, and the EU. Together, these three nations account for nearly half of all global wheat exports. Russian exports are projected to have fallen 30% in July compared to last year, while Ukraine has exported only a third of last year's shipments. The drop in exports pushed spot prices at Black Sea ports in Romania and Bulgaria up by an average of 8% last month, and also helped stabilize Paris wheat futures. Russian wheat exports, however, are expected to rebound in the coming months, which could put downward pressure on global prices.
So Russian exports are slow and U.S. exports are actually great. And what's going on in the wheat market? Fresh life of contract lows posted overnight in SRW wheat. Fresh life of contract lows posted overnight in HRW wheat. And you guessed it, fresh life of contract lows posted overnight in spring wheat futures, which have acted probably the worst of the three classes. So we don't have any good news for you here either.
USDA reported 2 flash sales of corn on Friday. U.S. exporters sold a total of 14 million bushels of corn to unknown destinations for delivery during the 25-26 marketing year. Accumulated new crop corn sales are up a whopping 54% compared to the same period last year.
Yep, we're doing great. We had this chart for you guys on Friday. Third best book of new crop corn export sales. And the only years that were better were associated with Chinese buying. And we don't have Chinese buying yet. We're doing a ton of business, and we desperately need this to continue. And I agree. Yeah, it feels like it doesn't matter. The corn futures, these corn's like 2 cents from life of contract lows this morning. So no, it doesn't feel like demand is great, but it is.
The stock market tumbled on Friday amid disappointing economic data. The Dow Jones fell 1.2%, the S&P 500 declined 1.6%, and the Nasdaq dropped 2.2%. The sell-off was triggered by a weaker than expected jobs report, which revealed that the economy added only 73,000 jobs last month, well below the projected 100,000. Prior months were also significantly revised lower, suggesting that the labor market has been weakening for a while. The data increased expectations that the Fed may cut interest rates at its September meeting. Markets were also pressured on Friday by Trump's most recent round of tariffs.
S&P has acted very, very well. We're up about 6% year to date. We're up 29% from that low that was posted in April, which was like your tariff scare / Liberation Day low. We're up about 17% over the last year. So that was not a great looking bar on the weekly chart last week. The market's up this morning, but if you find some follow through selling here early this week, you could very easily see some sort of larger scale correction. What did cattle do on Friday?
Cattle futures bounced back on Friday after a sharp decline on Thursday. Live cattle were 50 cents to 235 higher. Feeders were $1.02 to 320 higher. Cash cattle trade was also higher last week. In the Texas Panhandle, cattle were $3 to $5 higher compared to the prior week at 235. In Kansas, cattle were $4 to $5 higher at 235 to 236. Up here in Nebraska, cattle were $2 to $3 higher at 245 to 247. And then over in the Western Corn Belt, cattle were mostly $5 higher at 245.
Refresh my memory. So Thursday was the big nasty down day.
Yeah, we had limit down in some of the feeder cattle contracts.
And then we saw a marginal recovery Friday.
Yeah, a marginal recovery. I mean, we got back like a quarter of what we sold off on Thursday, but on the week we were actually up with both feeder and live cattle contracts on average.
So that reversal in feeder cattle, in my view, and I'm just imagining what the chart looks like in my head because I don't have it in front of me, the reversal to the downside on Thursday has not been negated, given that the recovery was only marginal. So I'd still be maybe slightly concerned for the moment. Outside markets, the Dow is up 280, the S&P is up 42 points, attempting a recovery. Treasuries are off a little bit. The dollar index is off. Crude oil is off $1.19 in the September WTI at 66.14. Gold's up $11. Have a great week, guys. I will be back on Tuesday.